So are you the type of person that I would contact if I won the lottery tonight?
Yeah, we can do that.
You would do that?
Yeah, we can do that.
Because I'm planning on it.
Take a moment to breathe, grab a beverage or two. We got professional guests with lots of stories for you. So take a seat right here and join us on Careers Over Beers.
Welcome to another episode of Careers Over Beers. Ladies and gentlemen, thank you so much for tuning in and listening and subscribing and spreading the word and everything you do. I really appreciate it. Today I got another episode with somebody in the money business. Is that right?
Financial planning.
Financial planning. So
Personal financial planning.
So you would be considered a financial planner.
Yeah.
Is that what you would call yourself?
Yeah. I mean, some people do financial advisor. It kind of just depends on what their service area is.
Mm-hmm.
But we kind of do it all. I mean, we'll do investment management, which is, what you usually think of when you hear the word financial planner advisor.
Right.
Then we'll review your insurance. We'll do life insurance if you need it. But we don't push it or sell it or anything. It's just, if it's part of your comprehensive plan, then
You're not an insurance salesman. You're not going to...
No, we're not going to go out and push it by
Yeah.
any means. But I mean, if you do need it, I mean, there is a need for term life insurance. I won't recommend whole life insurance for anybody, especially under the age of 40.
Right? Yeah. Like when I had Allison Betson on, shout out to her actually. She was I'll keep wanting to say real estate agent. She was an insurance agent.
Yeah, I watched that episode.
And she's telling me to get insurance when I'm 27, and I'm like,
you personally, you won't. I mean, you don't need it if you don't have
what
a
the
kid,
hell, Allison?
Don't have a house, no debt.
No, no worries.
I mean, even if you do have debt, it would just, be
It
forgiven.
would get passed on to people that I don't talk to anymore.
It wouldn't even be that. I mean, unless it co-signed on it.
Yeah. Well, cool. Introduce yourself. Your name is Jarrod.
Yeah, my name is Jarrod Jansen.
Jarrod Jansen.
I work with my dad, Heritage Private Wealth Management. We just do personal financial planning, investment management. So like I said, it goes from insurance, investment management, estate planning, retirement planning is a big one.
Mm-hmm.
So we help you make sure you have enough for retirement when you retire, and then we'll help you with all the distributions that come out after that and help you with Medicare and Social Security claiming.
Oh, yeah. So you do a lot of things.
Yeah.
A lot of services there we'll get into. But first, we have some Voodoo Ranger Imperial IPAs.
Yes, I've probably been drinking these Voodoo Rangers for probably 2 years.
Really?
They keep coming out with new flavors. But this is just one of the most common ones.
Yeah, and these are 9%ers, I believe.
Are they 9 or 7?
Pretty good.
Yeah, and you can barely taste it. I mean,
Yep, 9% on the case here.
Yeah.
So we're gonna get lit. 9%'s pretty good, man. 6-pack of these will do you good. It's not like drinking 6 Bud Lights.
No, that's for sure.
Yeah.
Especially a 6-pack of these on a Sunday football.
Oh yeah, yeah.
It'll last you all day long.
Get your mind right.
Yeah.
Cheers, sir.
Cheers. Appreciate it.
I'm pretty sure that I've had Voodoo Ranger on here once before. I can't remember though. I know I've had it just going to the bars and stuff. Mm-hmm. And I'm a big New Belgium fan anyways. I really enjoy Fat Tire.
Yeah, those are good.
Yeah.
And they got a good company, I think, out of Colorado.
Yeah. Yeah, so shout out to New Belgium. Good stuff. Well, let's get right into it, I guess. You kind of already told people what you do. Yeah. And I noticed your shirt says Private Wealth Management, like you said.
Mm-hmm. So
when I think of your company and I looked it up online and stuff, I think of like a wealth manager. Like you're helping out somebody rich.
So that's my dad. He's been doing this independently for 12 years, but he's been in the business for since 2000 at UBS. He is a CPA, and he's been doing taxes ever since he got out of college. But, so he's a CPA. I'm a CFP, which is a certified financial planner. It's essentially a CPA, but for financial planning instead of just tax work.
Gotcha.
So we do tax reviews. We actually do about 100 tax returns on the side.
Is it just as prestigious having a CFP versus a CPA? Because I know the CPA exam is a huge deal.
Yeah, it's rigorous. It's the gold standard when it comes to financial planning. There isn't really there's so many designations out there, but that's supposed to be the top one.
It's a hard test.
Yeah, it's
to pass that.
6 hours, 3 hours, get a 45-minute break, and then 3 more hours.
All on pen and paper or on a computer?
It's on computer, but it's proctored. So you go out to Prometric, and I think I took it at 8. Finished around 3, I believe.
Oh, man. It's an all-dayer.
Yeah, it's stressful, too, because, I mean, I'm just sitting there. It'll give you a preliminary pass or fail at the end. And I clicked, you got to take a survey at the end, too. So you click submit.
Oh,
then you're like, oh, no. And then you click submit again, and you're like, is this it? And then I think I got to click it one more time, and I'm like closing my eyes, and I peek open, and it says preliminary pass. I'm like, oh, my God.
Yeah, that's the worst. I've taken a test like that, too. It pops up, and you're expecting the score, and you're like, oh, shit.
Yeah. It just keeps you, it's cliffhanger.
Yeah. My dad he's a CPA as well.
Yeah, I saw that episode.
Yeah, he said that he took the CPA exam back in the 80s, and
That was
it was
pen
like
and paper.
a 2-dayer on pen and paper, like brutal.
That's a long one too. I mean,
Yeah.
I've thought about doing it, but there's no professional benefit to it for me per se, because I'm not gonna do tax returns forever.
Yeah.
The CPA, what it really does is it gives you the authority to talk to the IRS on behalf of your client if you are doing tax returns. So if I did your tax return for you, I just can't legally talk to the IRS on your behalf.
Oh.
But I can still prepare your return because I know how to do it.
Okay. So that's the difference. They're just certified.
Between individual preparers. I mean, you need a CPA, though, if you want to go into public accounting and like what your dad does, like finances for companies. And especially if they get the bigger and bigger the companies are, they need CPAs, and you need a CPA to do audit work.
Gotcha. And you just never had really any interest in going the tax route?
Tax work is terrible. I mean, it's like I said, we do about 100 a year, and it's takes up probably 70% of your time and maybe 15% of your revenue.
Yeah.
It's just a time pit.
So gross.
It's a time pit, and it's a hassle because my dad's system, like I said, he's old school, so he does everything on paper. I mean, he has software to do the return, but all the documents are paper. I mean, He doesn't scan anything in. They don't email it to us. They bring in a box of paper. I got to sort through it. We copy it, and then we go through it, put it into the software, and then we print out a return for them. We print one out for us, and then we file all that paper away. And it could be a faster process. So if I do end up doing returns later, we'll get more efficient. But
do you do your own tax returns?
Yeah, like I said, we do about 100 tax returns as well. And, and I do my own.
You do your own as well, yeah.
On the software. I mean, the software fee alone is like $90 now.
Yeah.
So we got to charge that, and then we have to charge for our time, and then by the end of it, it's close to $300-$200.
Man, it just sounds so mundane, you know.
It's not my favorite time of the year.
Going through all that paperwork and numbers and.
No, my favorite part about my education. It took me. I got a bachelor's at Wichita State, and then my dad was like, well, what do you want to do what do you want to do with that? And it's a bachelor's in finance. And I was like, well, I'd like to do what you do, because in your bachelor's program, they got several classes where you do like a simulation of stock trading. And I mean, that's always sparked my interest. And so I was like, well, it'd be cool to do what you're doing. And he's like, well, how do you want to get there? I'm like, well, the CFP is like I said, the gold standard. So that's what I set my goal on. And K-State has a master's program that you can go through, because you have to take like a certain amount of classes to even sit for this CFP exam. So I went and did that. I got my master's, and then I took the CFP towards the end of the master's program, and just kind of it all wrapped up at the end.
You went and got your bachelor's at Wichita State. Are you able to do the exam right after that? Or
no, because
you need additional schooling on top of it?
I mean, unless K-State does have a 4-year undergrad program that will qualify you for the CFP exam, but I didn't do that. I didn't know about it. And so once I got done with my 4-year, I found out about K-State's master's program, which would, suffice all those requirements that you need to sit for the CFP exam. So I took those. There's 7 classes that you have to take through that program. I took those, and I took a 3-month review course on the side just to get prepared for the exam even more. That was like a second job because I was working full time, and my wife was mowing the grass, doing the dishes.
Yeah.
She was picking up all the slack.
All the house chores.
Yeah, I really appreciate that. So you need some family support if you want to go through it.
Man.
Unless you're single.
Yeah. I couldn't even do it if I was single and it was all paid for. I'm terrible at doing school.
Yeah, it's not for everybody, but
yeah, I envy people like you that can just crunch through it and push through it, because I get easily distracted and then I just want to do other things and I push it all off.
Well, like I'm a big sports guy, so I like to watch football, Chiefs. And this last year was the first year I didn't have anything to do it, Sunday at 11:59. So I really got to actually enjoy Sunday football.
Yeah, that's a big one, man. We're like 70 days out right now.
Yeah, I know. It's a dry season right now.
Yeah, it is, dude.
Now I got to watch baseball.
Right? Yeah. That's only fun if you're sports betting.
Exactly.
Okay, so the traditional route is you need a master's degree to test?
No,
you just need a certain amount of hours.
You don't even really need a master's degree. Oh, for the test itself, you need to complete these 7 courses, which are the 7 7 sections of financial planning, which is pretty much practice management, like I said, insurance, investments, retirement planning, taxes, estate planning.
The 7 financial commandments, basically. The pillars of it.
Yeah, competencies is what they call them.
So is there any other requirement besides that? Could you just take those 7 classes without any degree and take the test?
You need to have a bachelor's degree.
You need to have a bachelor's degree. Okay.
Although I know there's some debate going around saying they should get rid of that to make it more inclusive, which it doesn't really matter to me. But
can you have a bachelor's in anything?
Yeah, it could be a bachelor's in fishing, I guess.
Really? Basket weaving.
And it's just, that's why it's kind of not really that
interesting. So med school is the same way, I'm pretty sure. I might be wrong, but I'm pretty certain that you can have I
think you can, but it dings you on your, because you got to apply for med school.
Yeah.
So if they see you got a bachelor's in basket weaving, they're probably not going to take you.
Yeah, I gotcha. So it's not required, but it's like, nah, probably not.
Yeah. And I know clients don't really know what the CFP is. They're more impressed with just the master's degree in financial planning. Mm-hmm. So I am really glad I got that and
it just looks better all around on your resume. And
especially because, I don't think a 50-year-old would want to have a 25-year-old managing their money.
Right, yeah.
A couple $1 million, all the money they saved up their whole life. I don't think they're going to trust a 25-year-old with it, especially if you don't have any of these designations or degrees.
That is kind of a weird position to be in, because especially when you first start as a private wealth manager or a financial planner, you're obviously not going to be wealthy, most likely, unless you inherited money or something.
No.
So it's kind of a weird thing to be managing some wealthy guy's money that's old and you're not wealthy yourself.
Yeah,
you're just trained in it, I guess, right?
Yeah, you're book smart in it, and the experience comes later.
Have you ever seen any distrust because of that?
Not yet.
By clients?
Not yet. I've heard of it from some colleagues, not like people I work with, but people in the Financial Planning Association. It's just a group of financial planners that get together and bounce ideas off each other and stuff. And there's a next gen group, and a handful of those guys just they got people that don't really trust them, people that will pass them up for a different advisor just because of that. And some people my age just have that case. What is it? It's called I forgot what it was, but just not feeling like you deserve to be where you're at.
Oh, I know what you're talking about. Imposter syndrome.
Yes, yeah. And a lot of young people feel like that. So if you go through all the stuff to get the CFP, then it's something you can look back on and be like, well, I kind of know a little something.
I kind of do deserve to
I kind of know a little something.
Yeah. That's really common amongst people that have wealth in the first place. When they're in a position where they're so successful already and they're like, how? Like, why? You just feel like a normal person your whole life, and then all of a sudden you have things.
Well, that's the crazy part about compounding interest is, I mean, you don't, especially like in a 401k where you're just putting money away every month, you don't really look at it. And then, 15 years go by and you already got $500,000 and you're like, holy crap.
Yeah, let's get into it. So how much should you be contributing to your 401k if you're 25?
Rule of thumb is 10 to 15%. If you can do more.
Of your gross?
Of just your paycheck.
Just your paycheck?
So you get $1,000, just put 150 in.
Now, are you a fan of Roths or traditional?
That depends on how much you're making. So do you know what the difference is between a Roth and a traditional?
I do, actually, yeah, because mine is set up as a Roth.
It's pre-tax and post-tax, and the Roth is post-tax. So you're going to get taxed on that if you put it in there this year. So if you're only making if you're single and you're only making $50,000, you're paying roughly, your marginal bracket's going to be 12%, but your effective tax rate's going to be closer to 10. So you're only paying 10% federal, and the state's going to be about 5 here in Kansas. So total, you're paying about 15% in taxes on that money that goes into your Roth. And then theoretically, when you retire and you pull it out, if your tax rate's higher than 15%, then you're ahead.
Gotcha. Yeah, that makes sense.
But
so that would be the only scenario though, because traditionally, if you look at history, tax rates usually only go up.
That all else equal is you're going to be, in a higher tax bracket
most of the time for most people.
Most people aren't. I mean, if you're making $100,000 or you're mid-career and you're getting paid pretty well, you're going to be paying close to total 30% in taxes. About 24-22% at the Fed level now, and then state caps out at 5.7. So total, you're paying close to 30%. And then when you retire, you're not going to have a whole paycheck. You're just going to be pulling Social Security. And then whatever you pull out of your retirement accounts is taxable income, which is generally...
I don't understand why you would ever want to do that, and why you wouldn't just pay taxes up front.
Well, not all of your Social Security is taxable. So it's not like only... They calculate 50% of your Social Security into your AGI, which is your adjusted gross income. And then you add in all your other taxable income, which tends to be more than what your actual paycheck used to be. I mean, it tends to be less than what your total paycheck used to be. So usually people say you're making $100,000, people usually will withdraw, just enough to cover their living expenses, which is only about $70,000, because you don't have to earn money to put into your Roth anymore. You don't have to earn money to pay Social Security tax. You don't have to pay any more Medicare tax. Typically, when you're retired, you don't have a mortgage or you don't have any other debts to pay. So you need a lot less cash inflow. So you have a lot less cash outflows. So typically, you're spending less in retirement than you were when you were working.
Right, unless you're just balling out.
Yeah, unless you're just balling out.
Unless you're 62 and you're like, let's go.
Yeah.
We're going to Vegas.
Yeah, and but typically, I tell people in their 20s, I'm like, a Roth is almost a no-brainer unless you're making over $150,000, $200,000, just because, the U.S. has about $32 trillion in debt right now. We're going to have to pay that off sometime. They're going to have to raise tax rates eventually.
That's my thought process. I can't, even if I was making buku bucks, I think I would still tax it up front just because I know the way things go.
You know what you're going to be paying now. You don't really know what you're going to be paying later. Yeah. So it's essentially a gamble. If you want to roll the dice, you can pay the tax now and then not pay it later. Or just say, I'm going to live real frugal in retirement, not going to take a whole lot of money out and be paying only 5% on it.
Yeah, that's the thing is like.
But that's where we come in.
Is it better to live frugal now when you're young?
It definitely is.
Or is it better to, but then you're not guaranteed your health and your life even when you're old.
No, you're not.
Right?
And that comes into play when we talk about, term life insurance out that age, and we talk about drawing Social Security because people want to take it at 62 because they don't know how long they're going to live. They don't want to leave money on the table. Although your payment gets reduced the earlier you take it. So there is a break-even point somewhere in there. We just can't tell you it unless you tell me the day that you're going to leave the earth.
We'll work that out with me when we're done with this. Yeah. When can I start buying the yachts?
Depends.
You
said you have a Roth?
I do have a Roth, yeah.
Do you know what percent you put in there?
Yeah, I put a lot in there.
That's good.
I think,
especially if you don't like need the money.
Yeah, mine is.
Some people are constrained to be putting in just 5% because they have to. They got kids to feed. They got bills to pay. So they don't have any other choice. I mean, if you have a choice,
I got some really good advice from my dad. Obviously, he's a CPA, and so he guided me along the way. When I first started working full time, I don't even think I knew what a 401k was. I didn't know what a Roth meant. I had no clue. Terminology was all foreign.
Some people say, "Yeah, I got a retirement account. Apparently, there's $401,000 in there." Like,
it says 401k.
Yeah,
I mean, 401 grand, right?
No, it's actually just section 401k in the IRS code.
Yeah. Wouldn't that be something, man? A company's just like, yeah, here's a 401k just up front. We'll go from here.
Signing bonus.
We're not going to make it an even 400. We're going to keep it at 401.
Yeah, but I like you said, a lot of people don't know.
I had no idea. Thank God my dad knew all the terminology and lives in that world, and he helped me out a lot. And one piece of advice that I always got that I stuck to was anytime you get a raise or something happens and you switch jobs and get a little more money, to just treat that as more money for your account and just don't even think about it being there.
Yeah, and I mean that's
especially if you're starting at a low percentage.
Yeah, that's always a good idea to do, especially when like I said, when you don't need the money. It's better than spending it on a new car or something like that depreciates in value. Your Roth account won't depreciate unless, at least not over 30 years it won't.
Yeah. And mine's weird too. I have like 3 different incomes going in, so it's kind of weird to handle. I'm in the military still.
Okay.
And so I have to deal with that whole deal.
Yeah, and the military's got the TSP and and the Federal Employee Retirement System, which is a pension. A lot of public companies don't have pensions anymore, so that's why the government's one of the best places to work.
It is, yeah.
Financially, I
recommend it to a lot of people, man.
I don't know about the work-life balance, but they do have good benefits.
That's totally dependent on what you're doing for the government. There's so many different sectors and so many different career paths you can take. But as far as like financials go, it's basically the old school American dream that you think of when everybody had a pension back in 1970 and we were living great. That kind of still is alive in the government jobs, just with all the benefits they have. But who knows how long that'll even be around.
A military stint is a lot cheaper than taking out a student loan to go to college.
Yeah. That's the most reason, including myself, that we all do it. Most people do it, is to get that free school.
Yeah. And are you going to go to school after you're done?
I've been going to school.
Oh, you have?
Yeah, I've been going to school for the whole time I've been in, actually.
And they're paying for it?
Yeah.
Oh, cool.
Yeah, they are paying for it.
I didn't know they did that. I thought you had to finish like 4 years or something.
It depends on what you're doing and how long you've been in. There's a lot of different factors at play.
Okay.
And so, lately I've only been doing like 1 class a semester.
Yeah, that's how the master's program was.
Yeah,
every 8 weeks.
So it doesn't even feel like I'm in school anymore, but I still kind of am. And they encourage it too. They encourage you to keep progressing in your education and training and all that. But
so where do you get the 401k at? Because that wouldn't be with the military.
401k is civilian employer.
That would be. I think that's a 403b, but
403b. Yeah.
403b.
I call it a 401 because that's what everybody recognizes. Yeah. When I'm talking to people that don't really understand that world, you understand it obviously. Yeah. Then I'll call my TSP a 401.
Yeah. Yeah.
But
employer retirement account.
Yeah. So what's your stance, like talking about 401s and TSPs and all that, what's your stance on how aggressive you should be with it? At what age? If you're 25, should you be throwing it all in the most aggressive fund you can?
It would be all in stocks. So there's stocks, which is equities, and then you have bonds, which is technically called fixed income. So people in their 20s and 30s and even 40s, honestly, should be, 20s and 30s, 100% in equities and stocks, stock funds. Usually your TSP, TSP is a little weird, but most 401ks have, large cap, which is like Apple, Microsoft, all those big ones. And then you got mid cap, which are smaller companies that you might not have heard of. But but they're different. I mean, they're still strong companies. Some are in the S&P 500. And you got small caps, which are just like newer companies that aren't worth as much as the giant ones, but they have more reward for risk. So they're a little bit riskier, but they'll reward you more if they do well.
And so when you're talking about those companies, like 500 of them, right? The top 500.
S&P 500.
When you invest in that in the S&P, you're basically buying stock in all of those at once?
Yeah. Those S&P funds, they just kind of mimic the S&P 500, which is just the 500 biggest companies.
So it mimics an average of all of their earnings and everything?
It's so if you got 500 companies, it'll take a fraction of each one and it'll sell it to you for maybe $72 instead of buying each company once.
Okay.
So that would kind
of confusing.
I did read about how much it would take to buy one stock of each S&P company. I can't remember what it was, but it's definitely more than $10,000.
Yeah.
So it's ETFs are usually you can usually invest in the S&P 500 or large cap, mid cap, small caps, and ETFs, which are exchange traded funds. It's essentially like an Easter basket, and then has a bunch of different eggs in it. People say don't put all your eggs in one basket.
Mm-hmm.
The ETF kind of diversifies all those eggs
for you.
So you don't have just.
So you shouldn't just throw all your money at Amazon stock and hope they do well.
Well, if I said no 10 years ago, I'd look stupid. So
right.
I can't tell you that.
Right. My dad talks about these companies. I forget the terminology for it, but he said there's companies that are always going to, over time.
Yeah, those are value companies, dividend-paying companies. They're just always going to be there.
Always going to be climbing. Always going to be there, as far as we know.
Yeah, as far as we know.
Unless something catastrophic happens.
The thing about those is there's not a whole lot of upside. So if you get one of those large cap, they're usually more defined. Established. They've been around forever, and they pay a dividend. There's not a whole lot of upside to them. They just do their steady 1%, 2%, 3% growth every year.
Mm-hmm.
If you get those smaller companies, say it's like a brand new biochemical company, and they come out with a cure for Alzheimer's, and they're just going to shoot off like a rocket.
Yeah.
That's what those riskier
you miss out on the
are.
Thrill of something crazy like that happening if you just invest in those.
So it's good to be in the large, the mid, and the small.
Yeah.
You want to be in more small the younger you are, because you got more time to let it grow.
Right.
And then you want to gradually shift your buckets the older you get. And then once you're in your 50s, then you want to kind of start looking at fixed income.
Slower down.
Which fixed income kind of usually fluctuates off of interest rates. And since the Fed hiked interest rates last year and a half,
mm-hmm.
Fixed income has plummeted because they work inversely. They inverse the interest rate that the Fed essentially sets.
It's crazy how that all works, isn't it?
It's complicated.
What is the Federal Reserve's role in all of that?
The Federal Reserve is supposedly an independent agent.
But they loan all the money they make to the government, right?
No, well, honestly, I can't tell you off the top of my head.
We're getting into some shit here.
So what they do, their main goal is to keep employment low and keep inflation low. It's the Federal Reserve's only two goals. And they have a couple tools to do it. They can raise the rates, which what everybody has heard about the last year. That's the overnight rate that banks lend each other. So say I go to Legacy Bank over here and I take out, say my account's $1 million and I take out 900,000 of it, they're going to have a problem. So they're going to need to go to a different bank to borrow money to meet some reserves that they're required to meet every night. So they have to go borrow money, and they borrow money at that Federal Reserve interest rate, which is set by the Fed.
Okay.
And they kind of benchmark their auto loan and their mortgage rates off of that rate as well, just because they take your money and they invest it in these securities, or they turn around and loan it out to other people for an interest rate. It's just,
man, that's wild.
it is literally a big circle of People
loaning and loaning
people
and lending.
owing money. Nobody actually owns money.
Nobody owns money, and that's what's crazy. If you look
and the entire banking system is kind of
the entire banking system. Like if you really want to dig into it one day and look into it, I've done this before. You look at a bank and you're like, none of our money actually really exists there. You own an account at Legacy Bank, right? The cash isn't right there.
It's not right there. They turn around and give it to
lended and
else.
borrowed by somebody else,
Exactly.
and it exists somewhere else. So where does it actually exist? You keep
in our heads.
in our heads, yeah. It's not real. Currency isn't technically real.
No.
It kind of just lives in our imagination, and because we believe it has value.
$20 bill only has value because we think it does.
Because we think it does.
And it's backed by the U.S. government, but
that's huge. That's the reason it does have the value, because the government recognizes it. But if everybody just thought about it for a second,
if the government falls, then it's not going to have like any value. I mean, some people come to us and they're like, I don't get political. I'm not a political guy, but they come to us and they're like, oh, Joe Biden's going to take.
What do you think of Biden's new policy?
He's going to take my account down to zero, and I'm like, dude. If the market goes to zero, your money is not going to be safe in a bank. It's not going to be safe under a mattress, and none of your other possessions are going to be safe. It's going to be a free for all.
It's going to be a free for all, and it's not like the president is sitting there making these policies with your money.
No presidents really do.
If anything, it's their team that's doing a lot of the work.
It's lobbyists, really.
A lobbyist, yeah. There's a lot of factors involved.
Whoever's got the biggest wallet usually makes the most. They push the biggest agendas,
right?
If you got the biggest wallet, you get the most the best treatment, I guess.
Best treatment, yeah. You won't go to jail. I know that.
No, it's legal.
What are some crazy wealthy loopholes that you know of?
There are. I mean, I want to call them loopholes, really.
People want to call them a loophole, but there are legal ways to maintain your wealth and not pay as much, right?
Roth is a pretty decent loophole.
Why is Roth such a big thing right now? I feel like talking to older people that I work with and stuff, a lot of them say that was never an option. We never heard about it.
It's fairly new, actually. I think it came around in I want to say the 90s, early 90s maybe.
And it's interesting that it came around and people are latching onto it now, because I've always been told by my older coworkers that anything new retirement-wise is probably not in your...
Well, tax rates used to be a lot higher back in the day. I think income tax rates for some people would get close to 40%. So you don't want a Roth. You want to save the 40% today, and you're definitely not going to be, we're at very historical low tax rates, so the Roth is usually the best way to go for now. I guess a loophole would be, say you got your own business. If you're self-employed and you got some kids, you can have them work for you pay them $6,000, and they might just wash a couple windows, and then you can stick that $6,000 into a Roth, because you need to have earned income.
It's still your money.
Well, it would be their money, but it's setting them up for the future, and they wouldn't know about it.
Yeah.
That's a huge loophole, because like your dad said, the earlier you start, the better.
Yeah,
investing.
Definitely. What's crazy is I've done the TSP calculator before when I first joined the military.
Mm-hmm.
I think most of us do that when we first hear about it. Like, what? Like, what is this? You just dump money in this thing and it kind of grows?
Yeah.
So you can get on those calculators, and it's amazing. From what I've seen, when you punch in those numbers and you see, let's say you contribute from like 20 to 30, and you just stop. Let's just say you stop at 30 and you don't contribute anything else the rest of your life. Typically, you're going to have, averaging out, you're going to have more money when you're retired than if you started when you were like 35 and started dumping in.
Yeah. And
that's enough to scare the shit out of you when you're a young kid and you're like, whoa. And that's kind of what got into me,
And that's kind of what, kind of the same reaction that happens when we deliver a full financial plan to clients. Some of them are like 55, and these projections go out till they're like 90.
Yeah.
And so they might have $1 million today, and that goes out, and they might have they're supposed to have maybe $8 million when they pass away, and they're like, holy crap.
Yeah.
And they're like, well, yeah, this is how compounding works.
Compound interest works, yeah. Once it gets to that point where it's so big, it continues to just exponentially
Especially,
climb.
it'll grow even faster if you just don't spend them.
Even though from 30 to 60, it's a pretty low slope. It kind of goes.
Yeah.
But then even when you hit like 65, and then you start thinking about like, well, what if I wait till 67, 68 to pull out?
Especially if you don't need the money,
yeah, exactly.
It's definitely a case by case situation when it comes to Social Security. But yeah, compounding interest is probably the eighth wonder of the world.
It's amazing. And it's even more amazing. I wish every kid out there knew when they were 18 what it would do for them if they would just contribute a little bit of their money.
Yep.
And I think that if you show them on a graph,
well,
I mean, maybe I'm wrong.
Yeah, I've done a few other things where I try to teach people about financial literacy, and it just depends on the person. I mean, if they want to learn, they'll learn, but if they're not there to actually soak it in, then
it's probably
talking to a brick wall.
I mean, I'm sure some people don't catch on or care, but for me at least, when you see like million seems to be that threshold. When you tell somebody that your account's going to be $1 million, if you just do this,
yeah,
and it could be a little amount of money at first, and then let's say you get back. I think the average is like 7 or 7.5 over your lifetime.
Yeah,
typically
7 to 8.
I mean, you can almost say I guarantee you're going to have $1 million when you're 65. To some people, right?
With very little doubt.
Yeah.
Yeah, I wouldn't guarantee
you could be a millionaire, literally, with an average paying job. Most people don't realize that.
And if you got $1 million in a Roth account compared to a pre-tax account, that's
cash.
That's more. That's more than $1 million.
Yeah, that's cash, baby.
I mean, if you got $1 million in a traditional IRA, then you're probably going to have to skim off at least 25%, go to Uncle Sam.
Exactly. Yeah. Probably like 50% in 2060.
Yeah, I hope not.
It's only going to get higher, I feel like. That's why I'm a big fan of the Roth.
Another one of my favorite, I guess, hacks would be if you have kids, put them on your credit card. I mean, some credit cards don't allow it, but some
put them
do.
on like they get their own card on your account.
No, you just put them on there as just another authorized user.
And they get their own card?
I mean, you can give them a card, but they're not going to need it because you're not going to let them spend it, so just don't give it to them.
Oh, I see what you're saying. So technically, if I have a credit card, only I'm authorized to use it legally. But
unless you add another authorized
user.
Unless you
add an author. Okay, I got you.
And then, so you would give the company their social security number. They would add them to the card, and then they get, say you had that card for 10 years, then they get that 10-year credit history. And so they have a credit score. I know a lot of people do that. So when your kid's 20 and they want to go buy a house, they have some credit. Or if they want to go get a car, because I know when I bought my house, my wife didn't have any credit, so one of the banks weren't going to let her co-sign because she had no credit. So that's a good way to get, a hack for your children.
Just start building that credit up a little bit.
And then my other favorite, it's called a hack, but it's another good thing for your children is a 529 account for college savings. So that account you keep ownership of, and then the kid would be the beneficiary. And you want to put in Kansas, you get a state tax deduction for putting in up to $6,000. You can deduct that off your return, and then that grows 8-9% a year until they go to college in 18 years, and then by then he's got $100,000. He can take that out tax free to pay for school. So all the earnings are tax free.
Oh, okay, that's cool.
And
that's really cool.
And if he doesn't want to go to school, he can still take it out. You just got to pay tax and 10% penalty on just the earnings.
If he doesn't go to school, you can just cash out for yourself, and
he can.
He can.
You can do it too. If you want to keep it for yourself.
That might not be a good thing to let kids know.
Well, I mean,
hey, dude, if you just choose not to go, just cash that shit out.
They can't cash it out themselves because it's not their account. They don't own the account.
Gotcha.
But if if the parent still wants to help them in other ways that aren't school, then they can still, cash it out and then
pay a bit of a penalty.
But it goes, if you do it correctly and send the check to the kid will get taxed and penalized on it. But he's probably in the 10% tax bracket, so he's only going to pay 10% on it, and then a 10% penalty, which would probably be a lot less than his parents.
Gotcha. Okay.
So I'm probably going to set one of those up for my newborn.
Are you?
Pretty soon.
Yeah. Congratulations, by the way. You didn't tell people yet. You just
Yeah, we tried to get this scheduled 3 weeks ago. And
we had to reschedule because you were literally having a baby the night we were doing the podcast.
Yeah, my wife texted me in the morning. I was like, "All right, can't make it, Jesse.
Yeah,
I gotta go to the hospital."
Yeah. So let me ask you this one, because this is something I've been thinking about lately. Is if you wanted to loan out of your 401k, let's say you want to do a house addition, or you have a big project in mind, or whatever it might be, and you notice that your 401k offers you this opportunity to loan from it for whatever amount, let's say it's like 20, 30,000. What's your advice to people that want to do that or think about doing that?
My first advice is to not do it.
Don't do it? Bad idea?
If you don't have to, it should be there for emergencies.
Okay.
So if you had like an unexpected medical emergency, that's going to cost you quite a bit.
Let's say I want to build a brand new deck.
Oh, no, don't take it out of your 401k.
Don't take it out? Okay.
No. The 401k is for retirement.
Leave it at that?
Leave it at that.
Okay.
I mean, even a Roth, because you can take your money out of Roth tax-free, penalty-free, because you already pay taxes on it.
Is it penalty-free even?
If
you can just pull cash out?
Unless you get into your earnings. Your earnings are taxable and penalized.
But you can pull out of what you've contributed?
Your contributions you can pull out penalty-free.
Really? I did not know that. That's
Yeah.
good information right there. So if I'm going to the Kansas Star tonight to play blackjack, I can no problem pull out $1,000 of my TSP that I've contributed to.
Your TSP, your Roth TSP, you could.
Roth TSP, okay.
Yeah.
Well, good info
there is
Jarrod.
a little different. There's a little different rules when it comes to the employer plan, because those get mixed with your pre-tax money. It's a weird accounting that they do on the backside. So it's kind of prorated.
Mm-hmm.
So if you have like 5,000 pre-tax and 2,000 Roth, and you take the 2,000 out, it's still going to be 40% Roth and 60% pre-tax. Not the whole 2,000 is going to be penalty free. But if you do it out of Roth, just a Roth IRA account, then they can cherry pick your contributions.
That's interesting. So, how many have you worked with a lot of clients already in your career? How long have you been doing this?
So I started helping my dad probably March of 2020, I think.
March 2020?
21.
2021. So a couple years now. Yeah. Over a couple years now.
And I've been in school anyway for this since the fall of 2019.
Have you seen any examples of terrible financial choices people have made in their lives?
Yeah.
Can you point a few of those out?
One lady, she is over 59 and a half, so her IRA distribution was not penalized, but it is taxable. But she took it all out to pay off her mortgage because she kind of got afraid of the bank in California, kind of went under recently, and that kind of spooked her. So she made an emotional decision, cash out her IRA.
Was like
didn't think her money was
Great Depression era where you're gonna have to go to the bank and they don't have your money.
I'm not sure what ran through her head, but she took her money out of her IRA to pay off her mortgage, pay down her mortgage. She didn't pay it off yet. So I think it was, I want to say 40,000 that was taken out. And no, she took 60,000 out, used 40 of it to put towards the mortgage. So that money just went poof.
And the other 20 was just for fun?
Well, the other 20, then she came to us, and then we talked to her about it and talked to her about the tax implications that's going to have. That's an extra $40,000 in income.
Yeah.
That she's going to have to pay tax on this year.
Yeah.
She didn't know that.
See, I didn't know that either.
And
I'm glad you brought that up.
That's a very, 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 very bad tax planning.
So they count that as your income then?
Because they don't withhold money from that distribution. Because when you get a paycheck, they withhold money for federal taxes and state taxes.
Yeah.
So when you file your return, you're either short a little bit or you get a refund for a little bit. But this was a $40,000 paycheck. She didn't get anything withheld, so she's gonna have to pay the whole tax when she does her return next year.
Man, she should have came to you guys before she did that.
Yeah, and so we talked to her about the extra money that wasn't put towards the house. And when you do take it out of a retirement account, you have 60 days to roll it into a new one, so to avoid the tax.
Okay.
It's called a indirect rollover.
So is that the same with everything? Basically, any capital gains you make, if you rolled into something new,
No.
It's not?
Capital gains are a little different because you don't have any capital gains in a retirement account because you don't pay tax on it year over year.
Even your investments aren't considered capital gains?
Not in a retirement account.
Really? Okay.
Because your retirement account's considered tax deferred. So all the taxes that you would normally pay year after year after year are deferred, and you only pay income tax on it when you take it out.
So that's specific to retirement accounts then? Because if you're just buying stock on your own and a company shoots up and you pull out, that's a capital gain.
That would be in a taxable brokerage account, like a Robinhood account.
Yeah.
I don't think they have retirement accounts yet at Robinhood, but
which is basically what your retirement account is, though. At the end of the day, right? It's just doing it on a larger scale.
The tax benefits are different because the retirement account will have, there's three, like an HSA. Have you heard of a health savings account?
I've heard of it. Yeah, I don't know what it is.
That is the triple tax free account. So you get a tax deduction when you put money in. It grows each year, tax deferred. You don't pay any tax each year. It grows, and then you take it out tax free when you use it for medical expenses.
But it has to be used for medical expenses.
And then you have your retirement accounts. So you got your traditional 401k. You get a tax deduction when you put money into it. It grows tax deferred. So there's two tax benefits right there. And then when you take it out, you have to pay the tax.
If it's not a Roth.
There's kind of like three rings to it. So the HSA, it's tax-free when it goes in. You get a deduction, so it's essentially tax-free when it goes in. It grows tax-deferred each year, and then you take it out tax-free. So that's three triple tax-free.
Mm-hmm.
And then your traditional retirement accounts, it either goes in tax-free or you pay tax on it, and then it grows tax-free for 30 years. Then the Roth, you can take it out tax-free, but the traditional one you have to pay tax on.
Right. So you're getting taxed either up front or at the end.
Up front or at the end. But then it grows those 30 years.
And with gambling accounts, like let's say you open up a DraftKings account and you're gambling, that's taxed just like a normal capital gain, like if you were playing at the casino or you won the lottery or something like that?
Well, first, so those are just, that would be income. If you make $600 in DraftKings, that's just income.
That's just income you need to count on your taxes when you pay?
They should send you a form. I think
1099 maybe?
It would be W2G is what the casinos give you, I believe. And they should give you a 1099 though.
So let me ask you this then: if I go to the Kansas Star and I'm playing blackjack, and I make $400, why is there no tax form or tax?
I don't think they do. I don't think they do tax forms on table games. I think they only do it on jackpots. Slots.
Yeah, but even if you win a large amount, like let's say you win $1,000,
you're supposed to report it. Yes,
you're supposed to. What if you win $10? Are you technically legally still supposed to report that?
I believe so.
Or is there
but you can also deduct your losses against your gains. So most people usually lose more than they win.
Almost all of them.
So I mean, it's typically a wash.
Unless you go once and hit it and leave.
It's typically a wash, but the only people that report gains is when they give them a tax form. And I think they only do that on slots.
So speaking of that, I kind of wanted to get into this area with you here. If I win the lottery, let's say I win the Powerball.
Oh, yeah.
What's the first thing I should be doing?
Hire an attorney, hire a CPA, hire a financial planner. First thing.
Okay. Is it better to take the payment option or the upfront cash?
Typically upfront cash, because essentially what the payment option's an annuity. So that's going to be a fixed rate of return. So I'd have to get the numbers in front of me, but normally when you take the lump sum, you can invest it, and you'll get more than what the other option is. Typically.
So are you the type of person that I would contact if I won the lottery tonight?
Yeah, we can do that.
You would do that?
Yeah, we could do that.
Because I'm planning on it.
Yeah, I haven't played it in a while. I think I played I think it was the Powerball when it got up to like $2 billion or something.
Yeah, everybody does, man. You got to buy a ticket if it hits that.
Actually, I read a post. I think it was when it got up to like 2.1 something billion. Yeah. Like the present value of that ticket was worth it. Like it was mathematically
$1 billion ticket.
It was mathematically worth buying a ticket.
I know. And what are you going to do with that ticket?
Typically, it's not worth. Like the odds of winning are so bad that it's essentially a donation.
They are so bad, but, my brain always flip-flops on this. It's hard for me to understand. I know that the odds are so bad that it's never going to happen, but then again, somebody's going to win it.
Yeah.
But
like I said, when the payout was so big that time that, like, it was mathematically beneficial to go buy a ticket. Like, your odds were so good.
Yeah.
And the payout was so good.
So
that it was
weird.
mathematically beneficial to go buy a ticket. Like,
I'm glad that it was. I'm glad there's a little bit of science to back up because everybody's buying a ticket when it's that high.
Oh yeah,
and then it climbs even more.
I remember I was 18. We just all my buddies just turned 18, and that's when it got up to like 1 billion or something.
Yeah,
we all got a ticket and watched it that night. It was fun.
Yeah. So what are you doing if you win $2.1 billion on the lottery ticket? What's your first steps? Are you gonna let people know?
Well,
are you gonna be anonymous?
No, I wouldn't let really anybody know. Honestly, I'd just get guac at Chipotle, and there'd be signs. There'd be signs.
You get extra guac at Chipotle.
Extra guac
right?
and a drink. I won't.
And everybody in line gets guac too, and make sure they know.
I want to get the water cup and fill it up with Mr. Pibb. I'd get the actual drink.
I see you frequent Chipotle. I do too, sir.
Mm-hmm.
Cheers to that.
Yes, I love Chipotle.
But you know what? I feel like that people are 100% going to know.
Oh yeah, I mean they have to.
In your personal life, just around you.
So
unless you just give it all away, I don't see how it's possible.
I mean, to get down to the nitty gritty, first you hit the attorney, get your estate plan in check. Because most people don't have an estate plan.
Tell people what that is.
So for most people, it's a will. Each spouse will have a will, typically giving everything to the other spouse, and then once that spouse passes away, it usually goes to your children.
How strong is a will, though? Because I've been hearing different things about that lately as well, like a will versus a trust or something else.
Yeah, so a trust avoids probate, and probate is when you have assets titled in your name. Excuse me. You have assets titled in your name, not in the trust. You have to open up a probate estate with the court here in Sedgwick County, and typically that costs money, and you have to hire an attorney to open it and close it and help you all the way along the process. If you have a trust, it's essentially your own. It avoids probate. If all your assets are in the trust, you don't have to go to probate. And it's more efficient for your assets to get passed down. Like it's
because they don't have to go through all those checks and balances that a will would have.
So if you don't have a will, you use the court's will essentially, which is probate. If you have a will, it still technically goes through probate, but it lists out already where everything's going to go. So it goes real fast, real smooth, and it's really cheap. And then when you have a trust, is usually when you got a handful of assets. I'd probably say over 500,000, or if you just got a lot of little things scattered all over the place.
Can you describe what probate is?
Honestly, no. I just know. Know.
Do you know what it means?
It's just when you die. I don't know what it means. I think it's like a Latin word.
Well, when you say like it has to go through probate or whatever,
it's just a process.
What are you saying? Like it has to go through this whole process?
It goes through the court.
Okay.
Probate's like the court.
Okay.
And it has to go through the court, and the court determines where your assets go.
Okay.
If you don't have a will.
I get what you're saying.
The court will determine where your assets go. If you don't have a will and you have kids, the court will determine where your kids go. Who's going to look after them? Yeah. Typically, in a will, you'll name guardians for your kids in a will, which is the biggest piece, in my opinion. And then usually, when you have kids, you got some life insurance as well. So usually, the life insurance will go into a trust, and that's all spelled out in your will. It's like if I pass away, the life insurance proceeds go into the trust for the kids, and then you usually have to name a trustee to look after that trust, that pool of money, and then you list some guardians, and typically you don't want the guardians to be the trustees because then you got a little conflict of interest there, and they can they can start paying themselves what they shouldn't. But no, typically, I mean, a will. If you go see an estate attorney, I mean, we don't do any estate documents because we're not licensed attorneys, so we can't draft any documents, but we can tell you about it.
Yeah. You can guide people, give them advice.
Yeah, and estate's the most complex part, especially when you get up there in assets. I guess back in the day, so when you die, you have to pay estate tax, which works the same way as income tax, except so on your income tax you have a standard deduction. On estate you have an estate tax exemption. And back in the day, it used to be only about $600,000. So if you passed away with $1 million, you would have to pay tax on that $400,000 in between $600,000 and $1 million. Nowadays, after Trump's tax law in 2017, it got raised up to like almost $10 million, and now it's indexed for inflation. And today, it's sitting just below $13 million.
Oh, really?
Per person. So if you have a couple, you have to have over about $26 million to even think about paying estate tax.
Really? So it's just cash to your descendants then?
Yeah.
Wow.
And most people don't have that much money, so there's not a whole lot of estate planning.
Yeah, I would say most people don't have 26 mil, just chilling.
And so trust used to be a big part of, kind of reducing estate tax. Nowadays, it saves on probate fees and attorney costs. And I mean, if you got like 6 kids, you don't want all your stuff going to the court through probate, because they'll go fight over it.
Yeah.
If you have a trust, then then
it's kind of set in stone how you
set
left
in stone.
It. Yeah.
And
so that's the way to go. That's
same with a will. A will can get contested.
That's kind of what I was asking though. Is like I've heard lately that the will isn't really set in stone, and it still kind of does go through the courts or probate.
It does get probated. It's just
the kids can argue it.
It's
right?
harder to argue it. And,
it's harder, but with a trust, from what I understand, it's like impossible. Like whatever I left to my kids in my trust is basically it, right?
That's basically it.
Yeah.
And like I said, the will, you can contest a will. It's just hard to do if it's
you got to take them to court.
If it's a legally valid will. Some people do it because Grandpa wrote, John gets
this on a napkin.
On a napkin, exactly. That can suffice as a will. It's just does the court think so?
I have some people in my family and friends that are medical professionals, whether they're an RN nurse or whatever, or a doctor even, and they say that people's last words can be considered a will.
They can be. I think that's I want to say it's
some kind of a weird law.
Holographic will or something like that.
But I'm sure that could be fought over easily in court if people wanted to contest that.
They can easily contest it.
Yeah.
It's just going to cost them money. And,
right.
And usually if your estate has to also hire an attorney, then that's going to just dwindle down your estate and, reduce the money that's going to get dished out to your heirs. So estate planning is a big piece of the financial plan, especially when you got young children. So say there's a couple, they had kids late. They had 3 of them. Now they're 70 years old. We'll say 65. And their kids are just now turning 20, 25 years old. Say they got $5 million. They don't want to dump $2 million on each kid if they got 3 of them around there. So that's where you kind of want to set up a trust, because in a trust you can list out, each kid gets the income. They can get the income off all that money every year, but they can't take any of the principal out until they're 25, 35, 45. Shoot, we've seen some people say they can't take it out till they're 65. It just kind of depends on how mature.
That would be my parents if they were planning this out. They'd be like, Jesse still won't be grown up by then.
I was going to say, how mature your kid is, how far along are they?
We're going to make it 75 for Jesse. I think he'll finally come around at that point.
And I know some people do the same thing, but with land. Like if you got farmers, especially out here in Kansas, they'll put it into a land trust and say, hey, all the kids get the income off this land, but they can't sell it.
Yeah.
They can only sell it after 100 years.
They can actually put that in the trust?
They can put that in the trust.
Really?
So the trust gives you a lot more control from the grave.
That's pretty cool.
It gives you a lot more control from the grave.
It makes you feel a lot better before you die, because you know that you just didn't write something on a napkin, and hopefully the court likes this.
And the opportunity cost for that control is it just costs more money to draft up a trust and get it finalized.
Yeah, but it's worth it.
If you want that much control, then
wouldn't you say, like, as a financial planner yourself,
oh, yeah,
wouldn't you say that's the way to go if you did have some money to leave behind?
Oh, yeah. trust is usually the way to go.
Yeah. And you've worked with several wealthy people, I'm sure, by now, right?
Yeah.
Quite a few of them. Have you ever noticed any traits that they have in common?
They're frugal. They know the value of a dollar. I can tell you that.
Yeah. There's a famous quote, and I want to think of the person that said it. I want to say it's Mark Cuban, but it's probably not. Or one of the Sharks, maybe.
Oh, yeah. I love that show.
Yeah, I'm not sure. But anyways, the quote goes that I've never met a millionaire that didn't pinch a penny.
Oh, yeah. It's true.
And then, do you find that to be true in your profession?
I mean, as bad as it sounds, if you're spending $10 at Starbucks every day, you probably won't.
Yeah.
You'll probably be living Social Security check.
Yeah, you're probably not setting yourself up very well.
I could be wrong, but typically when you have that mindset, hey, I can just drop $10 on this coffee, and then who knows what else you're going to drop. You're going to drop 50.
I agree. Yeah.
Drop $50 on this, drop $100 on that.
It doesn't seem like much to you at the time when you're making the purchase.
Oh yeah. I mean, for younger people, even myself, I fill out a cash flow statement every month. I literally list down each expense, where it goes, what's it for, how much it was, what day it was on.
Man, I wish I was like you.
I do that every month. I'll do it every month, and I've been doing that for the last 3 years. So then you know where your money's coming from. I'll record the income too. I mean, that's 2 lines for most people.
Yeah.
And then you record where everything's going out, and then you just analyze it. Are you bringing in more than you're spending? Mm-hmm. That's what it comes down to.
That's what it all boils down to.
That's what it all boils down to. I know a lot of people that say, hey, I only got like 100, 200,000 in my 401k, and they're pushing 60. Like, it really doesn't matter what your account balances are. It just matters how much is going out. Compared to your inflows, minus your outflows. And if you got a positive number, you'll be fine.
Yeah. That's interesting. Especially eating out too. The amount, like, I saw something on the news the other day that America has spent more, I think the number was something like in the range of $1,600 or something like that a month on DoorDash.
And I don't doubt it. I mean,
like an average.
I used to do some DoorDash only when they gave me coupons, but even then I still didn't see the value in it.
Yeah, but I mean, just the way the culture is, and I'm not dogging on DoorDash, I'm not dogging on people that do it, but
no, sometimes it's more convenient.
The change of the way that we live now, people have no problem paying that fee, getting food delivered, and it seems like the older generation would eat off of a rotisserie chicken for 2 weeks.
Yeah, I know
just to save some money. You know what I'm saying?
My dad, and there's a guy that office shares with us. He's an advisor too, but I mean 2 totally separate businesses. But they both we work across from Dillon's at 21st and Mays, and they'll go over to Dillon's and get like a clearanced salad for lunch.
Yeah, yeah.
And I mean, I just don't bring lunch, but I just don't eat. But
you just intermittent fast that shit.
I try to most days, unless I got like a coupon for something.
It's that's a good way to lose weight, is just skip a meal. Unless you're like me and you make up for it all when you get home.
I got that pregnant weight, dude. Everybody's bringing us food.
You just got the dad bod
for the last 2 weeks, man. Yeah. I was eating good. I didn't have time for the gym, so
yeah. That's a real thing. The dad bod kicks in. But you know what? That is kind of funny that you say that, because one misconception people have is that the more flashy you are, the more assets you have, the more you can just throw money around at the bar or throw money around at the restaurant, the richer this guy is. And in reality, people with real money...
They probably got some credit card debt.
And the guys with real money are probably driving an older car.
Oh, yeah.
They're probably bringing their lunch.
Have you heard Warren Buffett's house? He still lives in the same house, I believe. That he bought for, $20,000-$30,000 something dollars 30 years ago. Never moved. Yep. Has the same old crappy car. He's very frugal, smart with his money.
Right. And so I think there's a lot of truth to that there's people living amongst you that you think are cheap asses, and they're probably rich.
That's actually what kind of blew my mind was, a lot of these 50, 60-year-olds, they have money. They just don't show it.
Yeah. I mean,
especially out here in Kansas. There's not a whole lot of money to spend your money on.
At the end of the day, what are you showing it for?
Yeah,
you know what I'm saying? Like, if you actually have money, why would you want to show it off?
You don't.
You know the power of it once you get it, and you realize, like, there's more I could make with this, for one.
And that's that's a thing retirees have a problem with, is spending their money. They just don't want to spend it because they've lived 40 years, pinching pennies.
Yep.
And they just, because when you retire, it's literally the company kicks you off your email and you're gone.
Yeah.
Especially if it's a big company.
Yeah.
And they have a very hard time going from save mode to spend mode. And they should be spending because, they worked hard for all that money.
You worked hard for it your whole life. Use it up.
And that's another thing that we do. We help you on the emotional side too. We're like, hey, you have the money to spend. Like, what do you value?
Yeah.
Like, what do you want to spend this on? Do you have kids that you want to take on vacations? Some people have so much money that we tell them to start gifting money to them because you can give up to $17,000 this year without having to file a gift tax return.
17,000?
Mm-hmm.
Oh shit.
Per person. So husband can give 17 and the wife can give 17. If they got that much money.
Mm-hmm.
But usually by then the kids are around 40, 50 years old too. So it's not a bad idea to do.
Yeah. So working with all this wealth, working with all these people, all these clients, do you think that there's a certain threshold that you hit when it comes to your salary or the amount you make in your life where you're comfortable and happy?
That obviously is subjective. There's
I know there's a ton of factors.
I know comfortable and happy could be, maybe 100,000 for one person and 60 for the other. But
sure,
it definitely depends on just your cash outflows. Like, how much do you need to pay all the bills and keep a roof over your head? I think that's what a lot of people want. They
if you just had to throw a dart though and pick a number that you think is the magic number, like where
you're in Kansas,
you're probably doing pretty well.
Here in Kansas, if you were lucky enough to get a house already, probably 100,000.
100,000.
Married couple. Yeah.
Singles probably less, obviously.
Yeah, way less. 60.
So let's say you're just living by yourself.
Yeah,
60, you're probably doing good.
Yeah, you're doing
living
great.
Comfortably.
60. 60 includes a hefty retirement contribution.
Yeah.
All that other jazz.
Yeah. So it's not even like something out of reach, and a lot of people feel that way. I think that to be happy, they're just, how could you make $300K a year? They see this stuff online, especially now, TikTokers or YouTubers that make like crazy amounts of money, like 200 a month, 200 grand a month.
One kid that reviews toys makes like 26
million. That's what I'm saying. Yeah, and people see that and they're like, man, how can I do that? Blah blah blah. And I think they're missing the point.
They are missing the point.
Like, you can live very well, very comfortably.
If you're making 60,000, but you just hate getting up in the morning, that's different. That's not happening.
Right.
You could be making 100,000 and you just hate getting up.
If you hate getting up in the morning, period,
that's
you need
different.
to figure something out.
That's different. If you got to love what you do, or at least tolerate what you do.
At least feel rewarded when you're done doing what you do.
And I tell people, they're like, man, I really just don't like my job, but it pays well. I'm like, how well does it have to pay for you to not hate it?
Where does it weigh
exactly
out?
It's got to balance out eventually.
It does, yeah,
because you got to get compensated for the work that you do.
And there's a lot of jobs out there. Government jobs definitely give you more time off.
Yeah,
they give you more sick leave. They're a lot more generous with things like that, so you can take that into your calculations, as well as like when it comes to vacation time off, leaving early,
work-life balance.
Where does that all come in at?
Mm-hmm.
To me, that's really high on the list. But
yeah, to some people, they don't care.
They don't care if you're making 150 and you're working almost 6 days a week. Constantly just working. Is that worth it versus making 80 and working like 4 days a week?
Yeah, if you got a family, then you probably take the latter, but
you will, yeah.
If you don't, then
depends on your situation in life and everything. So, yeah, it's wild, man. The talk of money is so weird.
It is
so many people are uneducated on a lot of this stuff that you're telling me tonight, myself included.
And I took one class. So for my master's degree, I took the 7 that you needed for the exam, and then you had to take 4 more to get the master's degree. And you can either do advanced financial planning or financial therapy. And I took one class in financial therapy, and it wasn't my cup of tea, but it's very interesting. It's just kind of how your brain works with money, kind of how people interact with money, because it's really all about how your upbringing was.
That's true.
If your parents didn't talk about money, you're not going to talk about money.
And that's another unfortunate reality of the world, you know, because I think about that often. I was blessed enough to have a dad that works in finances. Mm-hmm. That was his job. So he would give me advice left and right, whether I listened or not. And I took some of it to heart, and I'm thankful that I did now. But, you know, I can't imagine if I was born to some parents that didn't have any education in finances themselves.
Or if they fought about money.
Like, I can't imagine where I'd be at. I'm already irresponsible enough. Like, I would just... It's such a trickle-down effect for every family, you know what I'm saying?
Yeah, and it gets even worse, too, because, I mean, because they don't really get any education throughout high school. And they get none in college unless you go into finance.
You get none in high school. I didn't get any education.
Although I do know, I have seen a few states actually mandate some sort of financial literacy class nowadays. I'm actually very interested in teaching that up in Andale. Because my mom works there, and my mom works there, and she's mentioned it here or there, but I just don't have time right now.
Your mom works in the high school?
Yeah, she's the
teacher?
registrar. I don't know, somewhere in administration.
Really? Okay.
Yeah, she actually had to get that job for health insurance.
Oh, really?
Because, I mean, my dad's self-employed, so
yeah,
if he wanted to get health insurance, it would have been, you know, arm and a leg. So he's like, hey, just go hop on.
Just go hop on at the school.
Renwick. They got pretty good health insurance.
That's crazy.
I'm actually coming up on age 26 here, so I'm gonna have to get my own health insurance, and I've already been working it out with the newborn too. And
yeah,
that is one area I'm not very fluent in. Is health insurance. It's a maze. It's hard, especially if you don't have like an employer. Because my wife, she works part-time, but they don't even have group health insurance, so we'd be on our own.
Mm-hmm. Yeah, that's weird. And that's something people have to navigate and think about, and they know nothing about it either, you know?
Yeah.
It's like thinking back to when I was 18, just getting out of high school, like I didn't have a clue. I didn't even if you told me the terms, if you said it to my face, I would be like, what?
What?
What are you talking about?
Yeah.
You just work and make money and that's it?
I mean, even in my first two classes, I believe in the master's program, I still was not clear on what a pre-tax and after-tax account was.
Yeah.
Like I was not sure what it was. And then once I kind of figured out like the three rings, like there's a, you know, pre-tax, I mean there's a tax benefit up front and then it grows tax deferred, or you either take it out tax-free, then that kind of cleared it up for me. But still, there's a whole lot that I had to learn.
Yeah.
And I learn a lot every week.
I mean, I'm glad you're talking about it now because this is important for people to hear. You know, this is probably stuff you talk about to your clients all the time.
Yeah.
And explain what it all means and what they can do. And yeah, that's cool. I mean, you obviously love what you do.
Oh, yeah.
So what's the best part about your job? What do you love the most about it?
I love teaching people about finance.
Teaching people about finances?
And financial literacy, just educating them in general. I mean, it's not the financial planning aspect, but like, even if you're not a client, you can shoot me an email and just be like, I got a question about this. I'd be like, hell yeah, I'd help you out.
Yeah.
I don't care.
I mean, it's probably pretty satisfying just having this conversation with you. I can tell.
Yeah.
Like, even for me, when it clicks and they realize like, whoa, like,
yeah,
that's a thing, or this is a thing. Like, it's very interesting.
And there's a few conversations I've had recently of like people that have, you know, a hefty amount of cash like in their checking account, and they're like, I don't really know what to do with it. And I'm like, well, do you have an auto loan? They're like, yeah. I'm like, what percent is that? And they're like, I think like 5. I'm like, well, just pay it off. I mean, it's an instant.
You already have the money.
It's an instant 5% return on your money if you just pay that off.
Yeah, why are people so hesitant to do that?
If you pay it off.
If they have the money.
Now, if you talk about mortgage, that's a little bit different. If you get a mortgage at 3% for 30 years, you know, you don't want to pay that off because you can take that extra money, put it in the market, you'll get probably way better than 3% over 30 years in the market.
Oh.
So if your mortgage payment's only $1,000 and it's at 3% for 30 years, and say you want to put $2,000 towards it, don't. Just take that extra $1,000, put it into a regular investment account,
like an IRA or what?
Or put it in there. Put it in a regular investment account.
Open up like a Robinhood account.
Robinhood, or those are just called taxable brokerage accounts.
Yeah.
Put it in there. You'll make 6%. Shoot, even if you make 4%, you're still up 1%.
That's a good point. See, this is cool stuff, man.
And even nowadays, since the Fed hiked these rates, you can go get a CD at Legacy for like 5%.
Yeah.
So why would you? That's risk-free money right there,
right?
And a CD, because you don't have to put it in the go put it in the market.
I got super lucky. I bought my house at a time when the interest rates were 2.25.
Oh wow, that's a little bit better than mine too.
I mean, I don't even know how that worked out, but I have imposter syndrome with that right now because I talk to people buying a house at this moment, and I'm like, I just don't know how crazy that worked out like that.
Well, even now, it's still, the rates are still technically lower than historical averages.
They are. You know, my dad told me when he built the house that I grew up in 1999, it was 9% or so.
Yeah, I think it's gotten up to 16 before.
And he said that was good.
That was good.
We thought it was great.
That's free money. Yeah, and I mean, I don't think rates will go up or down dramatically anytime soon. But
yeah,
home prices, however, well, they probably won't go down. So, I mean, if anybody's thinking about buying a house, I'd just say pull the trigger, because you can always refinance.
Yeah,
you can always refinance
so weird.
that interest rate.
So weird, the way that and the rate that we're spending money. And I see these surveys and stuff online, and I don't know how much truth there is to them, but the surveys and studies are showing that we're spending more than we ever have, even at a time when inflation is the highest it's ever been. Like we're in unprecedented times here.
It's credit card debt, I feel like.
It's got to be. I don't know what else it could be.
Credit card debt.
People aren't more wealthy than they were 10 years ago, are they? So how the hell is this all happening?
The 1% is, but the average American, no.
I mean, the middle class, which doesn't really exist anymore, I guess. You know, there was a huge middle class is still a thing, obviously, but it was much bigger in the 1960s, 70s, 80s. You know, the middle class ruled America.
Yeah.
And it was wealthy almost.
Yeah,
in today's terms, you were wealthy.
The golden age.
With the stuff you could buy. And it's just amazing that it looks like the wealth keeps separating further from the poor. There's this bigger gap in the middle, and yet we're still spending at crazier rates than we ever have.
Oh, yeah.
Is that just the culture? What is that?
Honestly, I'm not sure. I mean, I know what you're talking about.
How are we spending that much money? How are we paying for DoorDash every day and buying a new house and also owning 2 new cars?
Some people are. Not everybody.
You know?
Not everybody, but
it seems to be very common, though, especially amongst my friends, and I'm sure your friends. We're millennials, I think. We're on the edge. Well, you're a little younger than me, I think, but
a little bit.
20s, you know, early 30s. A lot of our friends and family and everybody are.
Well, here in Kansas, cost of living's probably one of the lowest states.
That's a good point.
Lowest states in the nation.
That's a good point.
Honestly, I don't in Wichita. I don't think you can get the same metropolitan feel for the price. Like, Wichita is one of the cheapest cities to live in.
That's why I think it's one of the best places to live in. It is, honestly.
It is one of the best. Yeah, I mean, financial wise, but
financially for sure.
Hey, now we got a Topgolf. Love that place.
Yeah, we do. You can do a lot of cool things. You can buy a great house in Wichita for what you would pay for an apartment.
Oh yeah.
In other cities,
It's in like 1 bedroom, 1 bathroom houses in LA go for like almost $1 million.
Yeah.
Holy crap.
But I guess what I'm trying to say is, like, the culture difference is, my dad grew up in the 60s and 70s.
Oh yeah.
And he said that if we went out to eat, it was a treat. Or if we went on a vacation, it was usually to Kansas City or Colorado or something.
Yeah.
And you know just as well as I do that people eat out every day now. People go on these crazy tourist destinations, vacations, and they're spending at crazier rates.
Yeah, and I think it shows because I think it was just went to a kind of like a conference, and they said about 61% of Americans don't have $400 in an emergency savings account.
Yeah.
And that's sad, but that's just the truth.
So they're just putting everything on credit?
Card, or living paycheck to paycheck.
Man, that's insane.
So I hope it's all going into their retirement accounts.
Right.
But even then, Fidelity, I think, said that their average retirement account is less than $50,000.
Really?
And that's not gonna last you a year in retirement.
How much? I know you're sick of hearing these exact numbers, and I'm putting you on the spot here. But let's say you're 30 years old. What would be a good number to have in your retirement account?
Yeah, I mean, there are numbers out there. I don't know if there's any truth to them, but the general, I guess, rule of thumb is what they say is to have 1 times your salary by 30 in your retirement account. I guess that can be a little bit different if it's a Roth versus a pre-tax. 3 times your salary by 35, 5 times by 40. I might be ahead of myself here. No, 3 by 40, 5 by 50, and then 10 by the time that you retire.
Okay. That's the general rule of thumb.
Yeah.
Interesting. What about like 20, let's say 21?
21.
Is there any rule for that?
No.
Because most people
Most
don't even
people don't have
contribute
a
anything.
job.
Yeah.
Most people don't have a job by then. Especially when you're 21 to 30, you're usually paying off student debt as well. So most people aren't too focused on that.
I mean, shit, though. If you look at the chart, like I was saying earlier, if you even threw in $50 a month when you were 20.
Oh, yeah.
I mean, even that, it's...
Yeah, I'm helping a kid that he's got student debt, and but he's still doing $100 a month to a Roth.
Yeah.
And I think I ran the numbers at 8%, and he did that for 40 years. It's still come out to about it's over 300,000.
Right, just for that.
Just for that.
Just for that.
And that's not including any increases in his contribution.
That's
or
not that's not including him waiting a little longer either. He's only 20, so.
I think he's 26, but still, he just started.
Okay,
For 35 years, I believe, he'll still come out with like $300,000.
Yeah.
If he only did $100 a month.
Insane.
And then he's also paying off student loans. So if you once you get those student loans paid off, and you put just half of that student loan payment towards
back into it
towards an investment account, you'll have well over $1 million.
Right. And I think people need to see that, dude. They need to see that on the graph. They need to see those numbers, and they'll get enticed, and they'll start throwing some at it. Just most people don't know.
I know when we first talked about scheduling this, I looked up some good book recommendations, but I forgot them already. Yeah, but there are. I mean, just Google, best personal finance books. And, I mean, maybe find the shortest one that you can find, and it'll hit the highlights.
Or even just get onto an online calculator.
Or YouTube.
Punch in some numbers. Throw some shit in there, and just see what it would come out to be.
Yeah, especially if you have your own 401k right now.
Yeah.
I'm sure the 401k provider even has like something like you said.
Some kind of a calculator.
Yeah. Yeah. They should have like a retirement calculator where you can go in, type in what you make, type in what you're contributing to your 401k.
Right.
And they'll tell you kind of an estimate on what you'll have when you retire.
Yeah. Oh, yeah, man. You got any other things to say about what you do? Do you have any things that you hate about it? Do you have any misconceptions you want to clear up?
No, I honestly don't hate anything about it. I mean, it's a great field to go into if you're thinking about it. Even there's so many career changers. I know a lot of engineers, for some reason, like to switch careers and go into financial planning.
Really?
And it's because they're technical people.
Their brain works like that.
Yeah. So even if you're 10 years into a job that you have right now and you don't like it, you can switch in an instant. And especially if you're in the military, like 80% of my master's class was militaries or they're just out of the military, just because of the GI Bill. And
I'm telling you, man, there's something there. Especially, I've seen a lot of young kids come in since I joined, and when you show them these things, because it's all thrown in front of you basically when you get back from basic, everybody's like, dude, do you know what you're making right now? Do you know what you can do with that? Blah, blah, blah. Do you know the pension opportunities, the TSP benefits? And so I see so many kids that are like 19 and they're like obsessed with it. And they could easily create a career in finance.
Oh, yeah.
Just from that, because they're like, wow, I didn't know that you could do this. You can make $1 million if you just chill and throw in some cash,
Yeah, and I mean, there's a handful of different career paths in financial planning. Because I know there was one guy in my class. He just got done with the military, but he's still pretty young. I think in his 30s. And he opened up his own practice, and he just focuses on like military folks.
Yeah.
And they come to him, and he knows all about the TSP, all about the pension system, all about all the spousal benefits.
Right. Yeah.
And he just kind of makes a career out of that niche. And
he found a little hole in the market there that he filled, and
I know there's there's advisors out in California that just work with people in tech.
Yeah.
Because they get compensated in stock usually.
Yeah.
Well, not completely, but that gets real complicated when you get paid in stock or bonuses in stock.
Or some companies just give you that as a
bonus.
Yeah.
Or stock options.
Yeah.
Those get complicated. We don't have those around here.
We don't?
No. I think the biggest company here is Coke, and they're private, so they don't have stock.
Speaking of Coke, I know some people that work at Coke, and
Same.
Charles, who is in his 80s now, I think, probably one of the richest guys in the world still, I would assume, top 10 maybe. He eats his sack lunch every day down in the cafeteria.
Same as Warren Buffett.
Yeah.
Oh, except Warren Buffett, he gets McDonald's every day.
Does he?
Yeah. It's actually weird.
What is it with McDonald's and Trump eats McDonald's all the time? That's his favorite restaurant. What is it with billionaires and McDonald's?
I have no idea.
They love that shit. It's cheap, I guess.
And it's I saw a video of Warren Buffett. Every time the market does bad, he gets like a bacon, egg, and cheese muffin. and then if the market does good, he gets like a sausage, egg, and cheese McMuffin or something.
Is that just one of his things?
That's just one of his quirks, I guess. I don't know. I thought it was weird.
Crazy. Yeah, it seems to be a common theme against. It might just be the fact that it's cheap, quick food, and that's what billionaires are about. Or
I guess they can,
millionaires that are future billionaires.
They have the money for the healthcare costs.
Yeah.
If you don't, I would strongly recommend take care of your body.
Yeah, meal prep. Don't eat McDonald's every day, but it is
because that's honestly one of the biggest expenses for retirees is medical expenses.
Oh yeah.
Especially long-term care.
Yeah.
I think a nursing home these days is $6,000-$7,000 a month.
Not to mention the funeral costs. That's a scam.
Funeral cost.
You can't tell me that's not a scam. You're gonna make somebody pay $15,000 for
maybe
a new casket.
To us young folks, it might be a scam, but to those more traditional people, they'd like to be buried in something they
I think
like.
that's so insane, though. Why?
Well, for people that got money to throw around, they don't care. But if you don't, then...
Yeah, but people feel pressured into that aren't wealthy. You know what I'm saying? Like, you want to you don't want to settle for a shitty coffin for your grandpa. You want to get him a nice coffin because he was a good grandpa.
So, yeah. So, I guess what we tell people to do is if they don't if they're comfortable doing it, go prepay it. You can prepay funeral expenses. So just go pick out everything that you want.
Yeah, but that's missing the point.
Oh.
The point that I'm making is that the funeral expenses are bullshit anyways.
It's just a waste of
money.
Why? It is a waste of money.
Like, it sounds morbid, but just throw me in a box in the ground.
One of my grandpas got cremated. Yeah.
You're going to end up food for worms anyways, whether it's now or 3,000 years from now. Yeah. What are we trying to preserve? Why are you buying me a nice Cadillac coffin?
Honestly, I think half of it's probably religious reasons, but...
Probably, but also the fact that somebody's making a lot of money off of these nice coffins and embalming services, right?
Yeah.
Because like I said, you don't want to go in there and be like, nah, we'll give grandma the box.
The box. The box and the ashes.
Yeah, you're kind of pressured into like, well, we better just get her the nice one. And some guy is making a lot of money off that.
Yeah, they do. They push it too.
They'll
push it.
I
haven't been there before, but I've heard about it.
Yeah, they do. And so we need to stop that. If anybody's listening to me,
isn't there a funeral home
I'm president.
Right across the street?
There's a funeral home right across the street, yeah. Yeah, but they understand where I'm coming from.
Yeah.
You don't need the Cadillac of coffins. Just give me the Honda Accord.
Yeah.
Something that's reliable.
Honestly.
Will do the job.
It all does the same thing.
It all does the same thing.
You're going to need it. That's what I tell people about cars when they go buy a new car. Well, I'm guilty. We just bought a new car for my wife because... apparently you need an SUV when you have a baby, but I think I agree with that now. So I'm not bending over.
That's one of the final steps of becoming a real dad.
Yeah, but yeah, cars are a waste of money as well.
I was going to ask you about that. Like, that's a terrible investment, isn't it?
It's not an investment, but it's just it's
people
a
look
consumption.
At it as an investment though because it's an asset that you own. It's not worth shit.
It's not an investment, but it's an asset. It depreciates. Your house is an investment, though.
Some people say a car is an investment, though, and that's wrong.
It's an antique.
That's wrong to say.
It is wrong to say. It's not going to go up in value.
No.
You and I both know.
Never, unless it's an antique that you're restoring.
You can ask a 15-year-old if a car goes up in value. He'll probably say no.
No, but why do so many people insist on getting the newest and latest and greatest cars?
I think that goes back to what we were talking about. It just kind of makes them feel like they have money. Maybe. I'm not sure. Some people have the money to spend, so they just think they should spend it.
Or they get suckered into the dealership saying, hey, we can give you the newest edition that's a year newer for the same rate you're paying for the old one, so why not?
Well, what I don't get is the people that get new cars every 3-4 years. Mm-hmm. See, because we just got a new car, and I'll probably hold onto it till it croaks.
Yeah.
If you're not doing that, then you should probably just lease. But yeah, cars depreciate right when you drive it off the lot.
Values. Drive a beater. Get that 90s Honda Accord.
Mm-hmm.
It'll get you to where you need to go.
A to B. Speaking of, I'm selling a car right now if you want it. The old car.
Are you? Well, tell people where they can find it.
On my Facebook.
No, we're about to wrap it up anyways, man. Do you have any last words of advice or anything to people out there that are looking at going into finances or people that are interested in finances?
Well, if you're interested in it as a career, it's one of the best. I mean, it pays well. There's really no upside cap to what you can make.
Can you make great money right off the bat, getting a degree in finances?
Not right off the bat. I mean, you got to, work your way up.
You got to prove yourself a
You got to
little
get
bit.
experience, especially. I guess there's nothing we didn't really talk about. So if you go, you can go work for like Wells Fargo and be an advisor there. There you're kind of limited on what you can make. But if you go independent and you're self-employed and you have to like pretty much solicit people to come be your clients.
At the beginning, at least. Yeah.
And then after that, it's usually your clients refer other clients, and then it just kind of
kind of builds on itself. Yeah. Like compound interest.
Exactly. So
that's riskier though.
It is riskier
when you get
especially
out
if you're younger.
Yeah.
Because I know, like I said, my dad worked at UBS, and that's kind of like Wells Fargo, Fidelity. It's a big wirehouse. He had clients there. Technically, when you leave and go independent, you're not supposed to take them with you, because they have like non-compete disclosures and stuff like that.
Kind of like being a real estate agent or a insurance agent. You kind of, or even as simple as something like plumbing. You don't want to.
Well, so what UBS thought is the clients that he worked with were UBS's clients, not his clients.
Right. Exactly. Yeah.
So if he left, they stay with UBS. Essentially, is what they
That's
thought.
what they think.
And there's ways to skirt around that. You kind of need to hire an attorney to make sure you get it clean and get everything transferred over cleanly. But once you go independent, then you're on your own, and there's a lot less oversight. You're the boss.
It's like any other industry at that point.
Yeah,
you got to do it how you want to do it.
Yeah, and then
but it's riskier.
And
it's harder at first because you don't have the clients.
Unless you're like him and you start, at a bigger place, and then you leave with people.
And you already know some people because
if
you have wealth, it's way less likely that I'm going to go to Jarrod Jansen's new startup than I would to some place that's known for that, right?
Mm-hmm. Especially if, like I said, if you have experience, you can go independent whenever you want.
Yeah.
And there's really not a shortage of financial advisors. They're everywhere, but there's so many people out there that need help. Like, there's so many people that don't know what they don't know.
Yeah.
And that's kind of where you need to go get a planner, just because you don't know what you don't know, especially when it comes to like retirement planning. Because I know a lot of people can Google, what do I put in my 401k? 10%. All right, they'll do that for 30 years, and then they retire, and they're like, well, now what?
Right. Yeah. But they do have to pay for your services still.
Yeah. I mean, there's hundreds of different, well, I wouldn't say hundreds, but a handful of different ways to get paid. We work as assets under management. So if we manage your money, we'll take, typically it's about 1% a year. And that's how we get paid. And that covers everything from any phone call, meeting, email, text, you name it.
Yeah.
There's other people that will charge, if I put together our comprehensive plans, they're usually about 30 pages. They'll, run you from age 60 to till you die. Some people will pay or charge like $5,000 per plan. But usually that relationship's just one plan. Here you go. Don't really see you again. But we do, ongoing planning. We'll give you the plan, and then we'll look at it every year. I mean, we'll meet however long you want to. If you want to meet every month, we'll meet every month. But most people are comfortable with 2 times a year.
Do you recommend doing this for people that don't even have any money at all?
I don't recommend not reaching out.
Or they're trying to build some wealth and they don't know where to begin.
What I recommend,
they don't have anything.
What I would recommend is reaching out. I mean, to me, I don't mind at all. Just email me, just any of your questions, and I'll kind of point you in the right direction. Some people don't. Some people are a little more uptight. Some advisors have minimums, like, hey, you need $500,000 to even talk to me. Like,
I've heard of that.
That's kind of dumb.
I've heard of those rules.
And that's not what I'm about.
Because there's a lot of IRAs that require that, right? Like, if you don't have this much money, we're not even going to talk about it with you.
Yeah, there's some people like that.
Yeah.
And, I mean, I get it. It's just they got to focus their time where they make money. But
especially if they have a lot of clients and they can't deal with everybody that walks up and wants to talk to them about finances.
But, like, I mean, shoot, I'll even meet with some people if they have, a laundry list of questions for free. I mean, all our consultations are free. They're essentially just interviews. People come in. It's more of an interview for you than it is for us. Like, it's got to be a mutual fit.
Right on, man. On that note, tell people where they can find you.
Our website. I just Google Heritage Private Wealth Management, Wichita, Kansas.
Heritage Private Wealth Management.
Yep. In Wichita, Kansas. I think there's another firm somewhere out in a different state. They pop up as well.
Oh, really?
Yeah. So when you click on it, it's just Jarrod Jansen. Our office administrator secretary is Christine Alsman.
Do you guys have socials like Facebook, Twitter, Instagram, any of that stuff?
No. He's old, so he doesn't have all the good stuff.
It's like, why do you need that?
No, just my email's jjansen@heritagepwm.com, and our phone number is 316-440-3062. And if you just call, just say, hey, I want to talk to Jarrod.
It's all in my description, folks. Go find it. It's right below the link you clicked on your phone or on your tablet or on your computer. It's right there. The website, the email address, the phone number. Jarrod Jansen is his name. Spell your last name real quick.
Jansen.
Jansen.
And I'm on LinkedIn. So
you're on LinkedIn. Okay, right on. Well, thank you for coming on, man. Thank you for talking to me about this. It's been super interesting. I mean, this is
I said, I could probably talk to you about for 24 hours.
Yeah, we've already gone an hour and a half.
Oh, wow.
Which is crazy. And it's something I'm very interested in, and I never was. I used to make fun of my dad when I was younger, like, you nerd. Why would you go into finances, right?
Shit, my dad would make me fill out my checkbook when I was in high school.
Yeah, my parents did the same thing.
Oh, my God.
I was like, why?
Bro. That made me not spend money.
I would write a check for something stupid, like going up to the store and buying a candy bar or something. They make me write a check and they make me write the balance in my.
Yep.
I'm like, this is such a boomer thing to do. What are you doing? I can log into my phone and find my bank account and my balance.
Exactly.
You know what I'm saying?
It's good habits, but it sucks.
It is good habits, and I get where they're coming from.
Yeah.
And they were a little smarter than us sometimes with the way they lived and their little checks and balances they had, because now it's so easy just to log into your phone. Yeah. I know what I spent. I saw it. It's right there. The chart is right there,
Especially if you write a check, you can see if it went through or not, like the next day.
Yeah. But, like my parents would make me do that thing where you balance it out.
Yeah, I did the same thing.
Yeah.
On each line.
And I saw my grandma do that too, and I just remember thinking, like, this is so stupid.
It's so dumb.
Why?
I had to print out my bank statement and go line by line. God.
Yeah. So that deterred me quite a bit. But, it's very interesting now, and I'm glad this conversation happened. I think that you're very knowledgeable, obviously, with what you do, and I wish you the best. So, cheers. Cheers, sir.
Cheers.
To a good
Appreciate it.
podcast. Thanks for coming on.
Thank you.